Picture this. It's 1999. Tech stocks can't stop climbing. Everyone from taxi drivers to dentists is day trading Cisco and Yahoo. The internet changes everything, they say. Old rules don't apply anymore. Fast forward to March 2000. The Nasdaq crashes 78% over the next 2 years. Now it's 2006. Housing prices have doubled in 5 years. Mortgage lenders are handing out loans to anyone with a pulse. Real estate only goes up, they say. We've never seen a nationwide housing crash. Fast forward to 2008. The entire financial system nearly collapses. Cut to 2021. Meme stocks are soaring. Crypto millionaires are born overnight. Everyone's a genius investor. This time, it's different, they say. We have better technology, better information. See the pattern? The uncomfortable truth. Markets don't follow a precise 7-year or 10-year clock, but they do follow human nature, and human nature runs on cycles. The timing varies. Sometimes it's 6 years, sometimes it's 12. But the sequence, that stays remarkably consistent. We have optimism, then euphoria, then denial, then fear, then despair, and then hope. Let's run through these things and see how so oftentimes traders can fall into these. Optimism. Confidence grows, early investors profit. Euphoria. Everyone piles in, prices disconnect from reality. Denial. First cracks appear. People call it healthy correction. Fear. Losses accelerate, doubt spreads. Then panic. Mass selling. How did we not see this coming? Then despair. Markets bottom out. And then, last but not least, hope. Recovery begins, and the cycle starts again. This isn't theory. This is a documented pattern recognition going back over a century of market history. So why do we keep falling for it? Here's what's fascinating. We know this cycle exists. Entire libraries are written about it. Yet generation after generation, we convince ourselves this time it's different. Why? Because the human brain wasn't designed for long-term market investing. We're wired for immediate threats and rewards. When everyone around us is getting rich, our brains scream at us, "You're being left behind." When markets are crashing, the same ancient brain yells, "Get out before you lose everything." Both instincts feel rational in the moment. Both are usually wrong. So where are we now? Right now in 2025, some warning lights are flashing. After years of historically low rates, we've seen massive valuations in a small group of mega-cap stocks. The top 10 companies in the S&P 500 now represent over 30% of the entire index's value, a concentration level we haven't seen since the peak of the dot-com bubble. Sound familiar? In the early 1970s, investors obsessed over the Nifty 50. They were 50 blue-chip stocks that supposedly could never fail. They traded at price-to-earnings ratios of 60, 70, even 90. People called them one-decision stocks. You buy and never sell them. Then 1973 hit. Those invincible stocks lost 50 to 80% of their value. This week's market turbulence, triggered by escalating trade tensions, gave us a glimpse of how quickly confidence can evaporate. Asian markets tumbled. The S&P 500 swung wildly. Gold spiked as investors fled to safety. Is this the big one? Maybe, maybe not. But here's what matters. The reaction was textbook cycle behavior. First, it's just noise, a healthy pullback. Then, maybe I should sell some positions. Eventually, how did I lose so much? So the lesson we must learn. Here's the one thing that can break the cycle for you. Build a system that protects you from yourself. The investors who survive every crash aren't the ones who predict them. They're the ones who prepare for them without knowing when they'll come. That means diversify beyond what feels comfortable. Don't let one sector, one stock, or one asset class dominate your portfolio, no matter how good it feels. Value matters eventually. High prices can go higher, but they can't stay disconnected from earnings forever. When everyone says valuation doesn't matter anymore, that's exactly when it matters most. Have a plan before emotions kick in. Decide now what you'll do if the markets drop 20%, 30%, or 50%. Not when it's happening and your heart is racing. You need a plan. Remember that crashes create opportunities. The best buying moments in market history felt like the worst times to invest. October 2008, March 2020, all of them felt like the world was ending. The mirror. Every few years, markets hold up a mirror to our collective psychology. We see our greed during booms. We see our fear during crashes. We see our selective memory during recoveries. The cycle doesn't exist because markets are irrational. It exists because we are. The difference between those who build lasting wealth and those who get destroyed isn't intelligence. It's not even luck. It's the ability to recognize the cycle, accept that you're part of it, and build protections against your own human nature. Because the market doesn't repeat itself. We do. And remember, the market is built up of millions of individuals. So the question isn't whether another crash is coming. It's whether you'll be ready when it does.